Welcome to our deep dive into the great retirement account debate, Roth versus traditional 401k. To set the stage, we'll compare how taxes impact your lifetime wealth, and we'll show where the real advantage comes from. We'll start with the core math, then unpack each account's benefits, and finally give you a practical playbook. Along the way, we'll use simple visuals and a couple of quizzes to help the ideas stick. Let's begin. Here's our roadmap. First, we'll explore the core math and why equal tax rates now and later yield equal results. Next, we'll look at traditional 401k advantages, then Roth 401k advantages. After that, we'll compare scenarios to decide which wins when, and we'll finish with an action plan, myth-busting, and quick quizzes. Let's transition right into the math that underpins everything. Here's the big idea. If your effective tax rate today matches your effective tax rate in retirement, Roth and traditional produce the same net spending power. In a Roth, you pay taxes up front and invest the after-tax amount. In a traditional, you invest the pre-tax amount and pay taxes later. If the tax rate is the same, the math cancels out and the net result equals. Therefore, the winner is determined by where your effective tax rate is lower, now or later. If it's lower today, Roth tends to win. If it's lower in retirement, traditional tends to win. With that foundation, let's examine each account's strengths. Let's formalize it. Suppose your effective tax rate is T and your contribution is C. In a Roth, you pay taxes now, leaving you with C times 1 minus T to invest. That grows by some factor G. At withdrawal, Roth is tax-free, so your net is C times 1 minus T times G. In a traditional account, you invest the full C now, which grows by G. At withdrawal, you pay tax at rate T, leaving C times G times 1 minus T. Those expressions are identical if the tax rate is the same. This proves that equivalent tax rates yield the same net. Consequently, the decisive factor is where your effective tax rate is lower. Now that you've seen the math, let's move to a decision flowchart to help you apply it. This decision flowchart begins by estimating your effective tax rate today and your expected effective tax rate in retirement. If your current effective rate is higher than your future rate, the flow directs you toward favoring traditional contributions. Conversely, if your current effective rate is lower than what you expect later, the flow points toward Roth. If you're uncertain or the rates appear close, the chart suggests splitting contributions to diversify tax treatment. It also emphasizes revisiting your estimates each year and after major life events, such as marriage, a job change, or a sabbatical. A side note reminds you that equal rates imply similar outcomes, reinforcing the core math we just covered. Traditional 401k contributions reduce your taxable income right now, creating an immediate tax savings. Because you contribute pre-tax, you effectively invest more upfront with the same gross pay. That can even help keep you within a lower marginal tax bracket for the year. Traditional contributions are especially compelling during peak earning years, or when you're subject to higher state taxes. Many retirees ultimately have lower effective rates thanks to reduced income needs, paid-off homes, and the ability to optimize withdrawals across accounts. These features can tilt the advantage to the traditional side during high-income periods. Next, let's explore where Roth shines. Roth contributions are taxed today, but all future growth and qualified withdrawals are tax-free. This structure is especially attractive if you expect higher tax rates later or anticipate substantial income in retirement. Under current rules, Roth employer plans do not require minimum distributions during the owner's lifetime starting in 2024, which helps you manage tax exposure in later years. Roth withdrawals also reduce the risk of large taxable income spikes that might otherwise affect Medicare premiums. Finally, many investors value the simplicity of knowing that every dollar in a Roth is truly theirs without future tax. With both accounts understood, let's compare them side by side. Here is the practical comparison. Traditional 401k tends to win in peak earning years when your current tax rate is high, when you want to preserve more take-home pay, and when you expect your retirement effective tax rate to be lower. It can also prevent bracket creep in the current year. Roth 401k tends to win in early career or lower income years, when you anticipate higher future tax rates, when you want a tax-free bucket for flexibility, when you're concerned about required distributions and Medicare premium surcharges later in life, and when you value simplicity. If you're torn, a split approach can provide diversification. Next, let's look at some common scenarios in table form. This table summarizes typical scenarios. In a high-income, high-tax year, traditional contributions often make sense because you capture immediate savings and invest more upfront. In an early career with modest income, Roth can be attractive because you lock in today's lower rate and enjoy tax-free growth. If you expect higher national or state tax rates in the future, Roth provides a hedge. If you expect lower retirement income, traditional withdrawals may be taxed at a lower effective rate. If you need more cash flow while still maxing your contributions, traditional requires less out-of-pocket cash to hit the limit. When uncertain, splitting contributions provides diversification and optionality. Now let's visualize diversification across income sources. This pie chart illustrates diversified retirement income by tax treatment. A portion comes from traditional 401k or IRA withdrawals, which are taxable. Another slice represents Roth withdrawals, which are tax-free. Social Security benefits are often partially taxable depending on total income. A taxable brokerage account contributes long-term capital gains and qualified dividends, often at preferential rates. Finally, health savings account distributions for qualified expenses are tax-free. Holding multiple buckets can help you fine-tune withdrawals each year to manage your effective tax rate. Next, let's map a simple career timeline to decide how to mix contributions over time. This timeline charts a typical path. In early career, when incomes and tax rates are often lower, Roth contributions can be attractive. In mid and peak earning years, traditional contributions can reduce high current taxes and keep you from drifting into higher brackets. During pre-retirement gap years or sabbaticals, you might consider Roth conversions or increased Roth contributions while your income temporarily dips. In retirement, you can draw from different buckets, traditional, Roth, taxable, to minimize lifetime taxes and manage thresholds like Medicare premium brackets. The timeline also reminds you to reevaluate annually and after major life events. With the strategy laid out over time, let's turn it into actionable steps. Follow this simple plan. First, estimate your effective tax rate for the current year. Next, forecast your likely retirement effective tax rate based on expected income sources and lifestyle. If your current effective rate is higher than your expected future rate, favor traditional contributions. If your current rate is lower than your expected future rate, favor Roth. If you are unsure, split contributions to diversify. Reassess each year and after major life events such as a raise, relocation, marriage, or a sabbatical. In low-income years, consider Roth contributions or partial Roth conversions. In retirement, blend withdrawals across account types to control brackets and Medicare premium thresholds. Finally, keep contributing as much as you can. Remember that traditional contributions usually require less out-of-pocket cash to reach the legal limit. Now, let's test your understanding with a quick quiz. Question: if your effective tax rate today equals your effective tax rate in retirement, which account produces more spendable money? Options: A. Roth 401k, B. Traditional 401k, C. They produce the same, D. It depends on investment returns only. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. They produce the same. When the effective tax rate is identical at contribution and withdrawal, the algebra shows the results are equal after tax. The key factor is where your effective tax rate is lower, now, or later. Question: which statement is most favorable to choosing Roth contributions? Options: A. You expect lower income in retirement. B. You anticipate higher future tax rates or very high retirement income. C. You want to reduce this year's taxable income. D. You plan to retire next year with minimal withdrawals. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Roth contributions are especially valuable if you believe your future effective tax rate will be higher, or if you expect substantial retirement income. Paying taxes now can be advantageous in those cases. Options A, C, and D more commonly support traditional contributions, which reduce today's taxable income. Let's dispel a few myths. First, the notion that Roth is always better is incorrect. The correct statement is that the better choice depends on your relative tax rates now versus later, and equal rates produce equal outcomes. Second, the idea that traditional is inherently risky overlooks the power of diversification across tax buckets and ongoing adjustments. Third, you don't need to pick one forever. it makes sense to reevaluate annually and use a split if you're uncertain. Finally, Roth employer plans no longer require minimum distributions during the owner's lifetime, starting in 2024, which increases control over late life taxes. Next, a quick but important disclaimer. Please note, this video is for educational purposes only and does not constitute tax, legal, or investment advice. Everyone's situation is different, and tax laws change over time. Before making decisions, consult a qualified tax professional or financial planner who understands your personal circumstances. With that in mind, let's reinforce our key takeaways. Here are the key points. First, if your effective tax rate is the same now and in retirement, the outcomes are equal. Second, favor the account that aligns with your lower effective rate. Third, traditional contributions typically shine in high-income years. Fourth, Roth is compelling when you expect higher future tax rates or you value simplicity and tax-free withdrawals. Fifth, if you're unsure, split contributions to diversify tax treatment. Finally, revisit your approach annually and after major life changes. To wrap up, use math instead of hype. Start by mapping your current effective tax rate and your expected retirement effective tax rate. If your current rate is higher than your future rate, traditional usually makes sense. If your current rate is lower than your future rate, Roth usually makes sense. If you're unsure, split contributions to diversify your tax exposure. Review the plan annually and adjust as your life changes. Now for a final note and a quick call to action. Thanks for watching. If you found this helpful, please like the video, share it with someone who needs it, and subscribe for more clear, math-first money content. In the comments, let us know your current plan, Roth, traditional, or a mix, and why. Your perspective might help someone else make a better decision.